Assalamu alaikum dear students. Hope everybody will be fine. So we will start our lecture from the remaining part of the previous lecture. In the previous lecture we discussed about the bonds, that definition the preferred stock, the definition of the preferred stock, and we properly explain all the aspects of the preferred stock, that what is preferred stock, how it will be issued, and how it will be traded in the secondary market. So now we will discuss the features of characteristic of the preferred stock, that what are the main characteristic of the preferred stock. So first one, characteristic of the, we can say that this is the general characteristic of the preferred stock. So preferred stock is often considered a hybrid or quasi security, is it offers different types of features of both the bonds and the common stock. For example, like preferred stock is like a bond, in that it is typically has a fixed percentage dividends. As we discussed, the dividends on a preferred stock, unlikely the common stock, is fixed, and it is similar to common stock in that the preferred holders cannot receive a dividend unless it is earned and declared by the corporations. When company earns and after that company declare it, so then the preferred stockholders will get their dividends. But in case of the debt holders, even though the company are in loss, but corporation will pay the fixed interest. So due to these two properties, that their dividends are fixed and the dividends when company earns and then declare those dividends like a common stock, so they have both the property. That's why this is called hybrid security or quasi security. So traditionally the private equity investors are keen on the dividends. However, most businesses they tends to care for less about the dividends. So preferred stock is classified on the company balance sheet, and if the company is liquidated, so preferred shareholder receives the priority. So first one, priority, preferred stock generally has the dividend, and that must be paid out before the dividends to the common stockholder. In a preference in dividends, priority in the dividends. How? When they received the priority over the common shareholders in the distributions of the remaining assets as well as are the dividends. Some companies choose to create more than one class of preferred stock, and each class may be ranked in a sequence in priority of claim or received equal priority. Means that first one, features and characteristic, that preferred stock have priority in the dividends. The company, when they earns and they declare the dividends, so first they will give to the preferred stockholder, and after this they will give to the common stockholders. Second one features that preferred stockholders, they don't have the voting right. Clear? Preferred shareholders, in some cases up to some limit they have the voting right, but mostly they don't have the voting right. Preferred shareholders may or may not having voting rights. Means the ability to have a say in the control and the directions of the company. In some instances, preferred shareholders have limited voting rights that allows the preferred shareholders to vote if dividends have not been paid out for a certain period of time. In other cases, preferred shareholders received full voting rights when they are converted to common stock. So the second one features they don't have the voting rights, but in some cases they have up to some limit they have the voting rights. It has the characteristic of both debts and equity. And I already discussed this one, that preferred stockholders have the characteristic of the bonds, debts, and also have the characteristic of the equity, common stock. How? Their dividends are fixed, either in amount or either in the fixed rate. So similarly, the bond return rate is also fixed. So this property is of the debts instruments. But look at, when company earns the profits, so they declare the dividends. Until and unless the company not declare the dividends and not earns the profit, so preferred shareholders, they don't claim for the dividends. So this is the property of the common stock as well as. So due to this, both the equity and debts property, this is called the hybrid security. Only and only this is the feature, the characteristic, unique characteristic of the preferred stock, that they have both the property. Preference in the voting, in assets in the event of liquidations. When company are liquidating, so the preferred stockholders have the rights before the common stockholders over the assets of the company. Means that to satisfy the preferred stock, company will sort out their assets first for the preferred stock. After that, when preferred stockholders, they are satisfied, so then company will satisfy their common stockholders. The next one features of the preferred stock is convertible into common stock. Preferred stockholders that are also convertibles to common stock by the wish of the corporations. preferred shareholders which are convertible into common stock, that is called convertible preferred stock. So preferred shareholders will almost always request conversion right in order to allow the preferred shareholders to convert shares of preferred stock into the shares of common stock. Why would an investor want to lose their preferred right for those of the common shareholders? This allows investors to lock in a specific dividend rate, while allowing the ability to convert to common stock and participates in a rise in the profits as the company growing up. The conversion rate is typically on 1:1 basis. Means that, let's suppose if you have 100 preferred stock, so 100 preferred stock will be converted to 100 common stock. Most notably, preferred shareholders will lose their liquidation preference, the ability to be paid before the common shareholders, if in the case of the company liquidations. So preferred stockholders have the convertible features, means that should be convertible into common stock. Preferred stocks are callable at the option of the corporations. Look at, if a company or a corporations, they issued the 5-year preferred stock or the 10-year preferred stock. So at the time of issuing, they specified a future date that after that time, the company have the right, corporation have the right to call back this preferred stock. Like look at, there is a 5 years preferred stock that is issued, and at the time of issued, company decided that, corporation decided that company have the right that after 2 years, anytime company can call back, can redeem this preferred stock. So now 1 year is over, 2 year is over. After 2 years, anytime company can call back this preferred from the preferred stockholders. So let's suppose after 3 years, company call back this one. Yeah, after 4 years, company can call back. Yeah, till at the maturity, when their maturity is complete, so company call back it. So callable at the options of the corporations means preferred stockholders should be callable or should be redeemable at the wish of the company, not at the wish of the investors. The next one, features of the common stock, of the preferred stock is fixed dividends. As we discussed in the explanation of the preferred stock, that preferred stock have fixed dividends, means that corporation will declare fixed dividends for the preferred stock. Either that will be fixed in amount, or either that should be fixed in percentage form. So till the maturity, the preferred stockholder will receive the fixed dividends. Like look at, if you make investments of $1 lakh in the preferred stock, and on that $1 lakh, 5,000 is your fixed dividends. Yeah, let's suppose 5% is the fixed dividend rate. So till the maturity of those preferred stock, you will receive the fixed 5,000 per year dividends. It doesn't mean that in 1 year you will receive 5,000, in the next year you will receive 3,000, in the next year you will receive 8,000, and then 10,000, then 5,000. No, fix 5,000, neither increase, neither decrease. But the dividends in case of common stock, that is fluctuated. So these was the main features of the preferred stocks, and hope you will understand. Now our next topic is bond. What does it mean by bond? So bond, one party in a borrower agrees to pay the principal amount and the specific interest amount to the other party, lender, up till a certain period of time. So bond is a debt instrument which is mostly used by company to generate funds, and this is a security in which companies give surety to investors that at a specific future period of time I will return back your capital amount plus with extra amount interest, fixed interest. So bond is fixed income instruments that represents a loan made by an investors to a borrowers, and typically borrower may be corporations or sometimes governments. So a bond could be an instruments or an security between the lenders and borrowers. Borrower will issue it to lender, and lender will receive a fixed income in shape of interest till its maturity. And when maturity come, so lender will give back this security, and the borrower will in returns pay the capital amount. So this fixed income instruments, that is called a bond. Bonds are used by company, corporations, municipalities, states, governments to finance the different projects and operations. Owner of bonds are called debt holders, or we can say that the creditors of the issuers. And the bond details, dear students, are included the end date or the maturity date, when the principals of loan amount is due to be paid to the bond owner, and usually that includes the terms of the interest, that either up to how total till maturity interest is fixed, or also have some variables interest. So these terms that are included in the bonds. Look at, sometimes the bonds interest rate that are fixed till maturity, but in some cases up to some period of time the bond rate are fixed, and after that period of time till maturity some then fluctuations taken place in the interest rate. So that's called variable interest rate bonds. So from the above definitions and explanations, we reach to the point that bonds are units of corporate debts that is issued by companies, and the securities is tradable assets. Bond refers to the fixed income instruments, and since bonds traditionally paid a fixed interest rate, that is also called coupon, to debt holders. Variables or floating interest rates are also now quite common. Nowadays, bonds interest rates or coupon rates are variables. Bond prices are inversely correlated with the interest rates. When the interest rates are going up, so the price of the bonds fall down, and vice versa. Or when the interest rate is going down, so the bond price is going up. I explained this point in the yield to maturities. Bond have the maturity date at which point the principal amount must be paid back in full to the investors. Governments, corporations, they are issuing the bonds in order to borrow money and to satisfy their long-term needs of the funds. Now the questions come in mind that why government they are issuing bonds? Government need funds for the roads, for the schools, for the dams, for the college, for the universities, for the infrastructures. So for the sudden expenses of the war. So they also demand to raise funds. So in this way, the government issues the bond. T-notes and T-bonds, treasuries, bonds. Similarly, corporation will often borrow to grow up their business, like to buy property and equipment, machinery, to undertake the profitable projects. Sometimes company have the opportunities to take projects, but they don't have the funds. So to undertake those projects, the company issued the bonds to generate funds and make investment in those projects and get benefits. For the research and developments, company or corporation needs funds. Similarly, for the hiring of the employees. So the problem that large organizations run into that they typically need for the more money than the average bank they can provide. So bond provides the solutions by allowing many individuals, investors, to assume the role of the lenders. Indeed, the public debts markets lets thousands of the investors each and lend a portion of the capitals they are needing. Similarly, in the bond markets, they allowed the lender to sell their bonds to the other investors or to buy bond from the other individuals as well as. And in this way, in the secondary markets, this buying and sellings taken place, and the investors are also entertaining the capital gains as well as. So this was the information regarding to the bonds. Then bonds have different types. So types of the bonds we will discuss in our upcoming classes, because on types of the bonds we have a separate chapters. Now our next topic is primary market and secondary markets, which we will discuss in upcoming class.